This paper is about tax compliance or tax collection. So one way to start to think about this is first of all, well, why do people pay taxes? The question has been asked for a long period of time. So of course there's the story about enforcement. So you know, you pay taxes because you're going to be punished if you don't. The problem with that is that people have found that given the levels of observed probabilities of being caught cheating on your taxes and the levels of penalties, they are too low to explain actual compliance that is observed in developed countries. So this has sparked a literature suggesting that there must be other reasons why people pay taxes, and it has led people to think about behavioral or what you call cultural aspects under the label tax morale. Often, sometimes people refer or think about social norms or reciprocity. And the first is basically an ethical inclination to pay taxes. Social norms, when people refer to social norms, you basically pay taxes because other people are paying taxes, and you're going to be ashamed if you don't. And the last one, which is very much related to the first, in our view, is that you pay taxes because you value the services that the state or the government is giving you. So because you value security, you value clean streets, you value whatever the government is giving you, then you're willing to, in a reciprocal manner, pay your taxes to someone who is treating you right. And obviously this has to be somewhat altruistic, because you can't have any expectation of having an effect on the actual provision of the good, because you are just one in many taxpayers, okay? So this is why, so intrinsically the idea of tax morale is really very similar philosophically, and I don't want to really get into that at all, to tax morale. So tax morale and reciprocity are really very fundamentally linked. But they've been thought about a little bit different, as different things oftentimes in the literature. In any case, that's not really central to this paper at all. We just want to think about some ways that whether, you know, what the relevance of these things is for tax compliance. Obviously, it's a major issue in Latin America, and these are just some examples of the levels of tax evasion, different kinds of taxes all over the region. This comes from well, various sources, and you can find them in an IDB report recently, a couple years ago, last year actually, or a CAF report also from 2 years ago. So certainly, I mean, and taxes are really a fundamental institution in society. It's really tax collection is much more important for development than you would think, just because of its effect on the government's ability to provide goods and services. I mean, and there's evidence to suggest that tax collection is important for empowering the citizen in terms of its role in holding the government accountable to its actions, and that in turn is important for development itself. So taxes are much more important than the money that the government receives. So it's a really significant and fundamental question for development. There have been several tax evasion experiments over time, and most of these have been conducted in developed countries and mostly related to personal income taxes. There are a couple of studies, a couple of experiments that have been done in Latin America. One looking at the importance of the value-added tax linkages across firms as a mechanism to enforce the tax compliance. And that uses that study looks at firms in Chile. That's the paper by Pomeranz. And there's another, which is I guess the closest paper to ours, is a paper by Castro and Carlos Cartassini from the IDB. Well, Carlos is at the IDB. Raúl Castro is, no, it's not Raúl, I can't remember his name, is, I think, in Buenos Aires. Sorry? No, it's not Fidel, no, not Fidel, I think it's maybe Raúl, close relative. So what they do is they send out, in the municipality in the province of Buenos Aires, they include messages on the importance of tax compliance, and the messages referring to they have one that talks about other people's tax compliance, so this goes to the social norms issue, and then another about what goods are provided with the taxes that you pay. And they randomize that, and they find some interesting results there. So that's closely related to our study. What we do is to actually, well, to explore the merit of this enforcement versus other hypotheses in tax compliance, looking at business taxes in a developing country. I guess I couldn't, in this case, because I'm talking about Venezuela, it'd be difficult to say it's developing, so it's underdeveloped, certainly. I don't know which direction it's going at this point. I don't think it's going in the developing direction. In any case, conceptually, I guess you've all been exposed to these ideas at some point, but the basic idea of Allingham and Sanmo from the 1972 seminal paper is basically showing in a basic rational model where individuals basically evade taxes depending on the expected gains and costs, and that that's where the probability of audit and the size of the penalty play a role. So, but the thing is that when this model has been taken to the data, the ability of this model to replicate the levels of observed compliance is very limited. So one thing that we'd like to think of in this model is that what really matters for behavior is the individual's perception about the probability of being audited, and their perception about the size of the sanction, and that certainly can be affected by public policy, even though, because people have imperfect information about the true probability of being audited, and they have imperfect information about the penalties incurred in the case of being caught cheating on your taxes. So this gives room for intervening with sort of softer tools, such as what information shocks like we do here, and not necessarily policy changes in themselves or regulatory changes. So the idea of tax morale, just I want to touch upon this briefly, tax morale has been typically measured as the individual's self-reported perception that paying taxes is the right thing to do. So it has this sort of ethical content to it. But really, the only way that this could logically be the case is that if the individual attaches some value to the existence of the state or whatever the state is providing, and so because the state has social value, the individual must contribute to its financing. But then, of course, this is closely related to the idea that because you value what the state is giving you, then you pay your taxes, and that's the basic idea behind reciprocal behavior from the individual towards the state. Reciprocity, you may not, I mean, as some of you may well know, is basically you doing a sort of a good deed or a good action towards another individual without the expectation of receiving anything back. And the reason the individual is not expecting to receive anything back and is doing it because it's valued the services that he's already received is because what you're paying is basically irrelevant for the entire budget. So the 1/n basically implies that just like voting, what your individual taxes are not going to make any difference. So you can't be paying your taxes in the expectation that that's going to, in itself, improve services. So that's why it's reciprocity. So then the idea is that people are going to be more likely to pay taxes when they perceive that the government is doing a better job. Okay, so one issue here, which has not been explored at all in other experiments, is what are the goods and services that, which goods and services are relevant, really? I mean, do taxpayers care about all goods and services provided by the state equally, or do they care about the things that affect them directly more than other services that they don't really benefit directly from? So these are issues that we're actually going to explore in this paper. So we do this in the context of the municipality of Sucre in Caracas. This is a large, one of the largest, the second largest municipality in the city. It has a population of about 1 million. A very high poverty rate, very high crime rate, very high informality, and there are about 7,200 registered firms in this municipality, and of those firms we selected 6,300 to be included in the study. The rest we excluded because they were really difficult to get to, because this municipality has some hills, and it's going to be very difficult to reach those firms that were sort of out on the outskirts of this municipality. So we decided to exclude those from the study. But still, we have 87% of all firms. All of these firms are supposed to pay their business taxes, and these taxes, these are really important for the municipality. They represent over 60% of all of the municipality's tax receipts. So what we do is we induce an exogenous change in the firm's perception about tax enforcement, tax morale, by sending them letters, basically, from the municipal authority, signed by the municipal, the director of municipal taxes. So this is basically the distribution of our experiment. We have 5 types of letters. We sent out 4,500 letters, but we were only able to effectively deliver a little over 2,200. And they were delivered between June 7th and June 25th of 2011. Okay, so the treatment shock came in this sort of 2-week period. Yes. We couldn't find the firm, basically. The thing that we hired a firm, we hired some of these places are like in really deep or difficult terrain to get to. If you a good part of this municipality looks like Rio's favelas. Okay, we have a huge barrio there called Petare, which is very much like a Brazilian favela, for those of you who are familiar with it. Very hilly places, narrow streets, and there's a lot of, I guess a lot of these firms are shut down, or some of them are not open all the time. Some of them are just difficult to find because the addresses that the municipal authority has on record are very noisy. So yes, this is basically because we just couldn't find some of these firm owners. Okay, so we have 5 types of letters, and the next slide gives a little bit of detail about what each of these letters says. We have 1,000 letters for 1,000 firms were sent the enforcement letter. We had 2 reciprocity letters. We had 1 tax morale letter and 1 placebo. letter, which basically had no significant message. It just was like a hi from the mayor or something like that. So this is the distribution of the delivery success rate. It's about half. We were able to effectively deliver about half, and there's really no difference across letter types. And the reason I have the last column there is that because of the outcome I want to look at is tax payments, or actually the data that we have, the administrative data that we have from the tax authority is actually the tax balance, the amount of debt that each firm has. Okay, so it's like stock. So we can track the stock of debt that each taxpayer has with the municipal authority, and because of course there are significant differences in the size, we wanted to normalize this debt by their estimated total income for the year. Okay, but there are some firms for which that data was not available. So of the 1,000 firms that received, that were assigned to receive the enforcement letter, we only have income data for 737 of them. Okay, so you can see that it's about 70%. About 70% of our data, of our firms, have this income variable with which we can then construct a variable that is the debt divided by the total estimated income for the year. Okay, and it's also pretty much evenly distributed across treatments. Okay, so so missing data on income is not related to treatment assignment. Yeah, because they're not related, because you see what I mean? I mean, it's 50%. Oh no, you mean no? Because there's going to be a correlation between being able to deliver and being and having income data. Yes, no, but basically over here. So yeah, that's a good point. I mean, but that's I mean, what's really relevant for me though is this last column, because what I want to estimate is the intent to treat. So this is the I mean, whether they're I do have IV regressions where we actually use, whether you actually did receive the letter, so we do have those estimates in there. But yeah, I don't have that column, if that's easy enough. Okay, so the enforcement letter basically described changes in the municipal administration and that were actually being put in place that were increasing the authorities' ability to control and enforce the tax legislation. The first reciprocity letter, which we're calling direct reciprocity, essentially highlighted the fact that the municipality is providing security services, cleaning the streets, and other business services that are relevant to the firms that are the object of our study. Well, no, the letter said the letter is hi. This is greetings from your mayor. We just want to remind you that paying your taxes is important, and don't forget that your taxes are used to provide the security services that you enjoy, and to keep the streets clean and your streets lighting going and things like that. And then another letter said something similar, but it said this money goes to provide social services, and provide assistance to the very poor, and things that are really not necessarily directly consumed, so to speak, by these firms. That's the indirect reciprocity letter. So the credibility, every letter, all of these treatments will have a credibility issue, no doubt. So if you But in every case, the actually enforcement threats have a very important credibility issue to deal with, because you can't run an experiment threatening people with audits and that threat not being true, because then eventually it's going to catch up to you, and you're going to lose the power of the policy instrument itself. So you can extrapolate that to everything, to every other
information shock that you're giving these people. You're telling them about the services that you provide. Certainly you're not lying. I mean, we're not lying on these letters. All of these things are absolutely true, but the perception that each individual has about the quality of these services and the extent of these services, and even just the individual sort of valuation of the services can be completely different. So yeah, no doubt. But I mean, you just don't think that there's going to be any difference between treatment and control with respect to that. Tax morale letter basically says pay taxes because it's good. And then there's a placebo letter that doesn't provide any information, any suggestion of anything. It just gives the address. It just maintains the last paragraph that is common to all previous letters, which basically says paying your, to pay your taxes you have to go to this address, or do it, through this other way. That's kind of those are the 5 treatment arms that we have here. The estimation is really very simple. As I said before, our dependent variable here is the total tax debt as a percentage of the estimated total income for each firm for the entire year. When each firm at the end of the year, at the end of 2010, around November or so, they have to go to the tax authority and say, I expect to have an income, a gross income this year of 100. And then based on that, they calculate how much tax they're going to have to pay each quarter in the following year. And then at the end, they go back to the tax authority and say, well, look, I didn't have an income of 100. I had an income of 80, so I paid too much tax. So you owe me, or I had a larger income, and so I owe you. And that's sort of the way it goes. We use that, each firm's estimate of their future income, as the normalizing variable. So, okay, so what we do is we essentially run a series of OLS regressions every 15 days, okay? Between May 15 and January 15 of the following year, we essentially look at the difference between controls and every one of these treatments. And that's our intent to treat regression, because what we use there is the assignment to treatment. And then we also do a regression, which is basically, usually, we estimate the treatment on the treated by interacting whether the letter was actually delivered or not. So restricted to those who actually receive the letter, and instrument that with being assigned to one or another treatment. And okay, the standard errors are clustered at the firm level in all of these regressions. So this is very clear to everyone. I'll skip this. So these are basically, I guess only one important thing here is that on the first column we have the difference between those firms that were assigned to the enforcement letter and the control, okay, over, from May 30 all the way to January 15 of the following year. First column is for all firms, and then we divide between large firms and small firms, and basically we just cut it down the median level of sales, which is $4,700. So what we see here, if you just take a quick look at this column, at the last column, all of the coefficients are really small, and they are, none of them are statistically significant. So all of the graphs that I'm going to show you refer to small firms, okay? So I'm just gonna, so essentially the point is that these letters are having effects only on firms that are below the median level of sales, okay? And this is true also for the IV, of course. If the intent to treat is 0, the IV will be 0. And this is what it looks like over time. So you see that the total amount of debt goes down right after the treatment, which is between June 15 right there and June 30. That's when the letters start coming in, and you start to see some effect.
these basically firms are paying their taxes that are going to become due in July. So there are two significant dates in this time period here, which are July and October. These are the dates when the quarterly payment is due, comes due. So your total debt jumps by the amount of your quarterly payment when basically at the end of the month of July and at the end of the month of October. So what this is saying is that these people basically pay their taxes before they come due. That's basically what's going on. Of course, you see, and what is the size of this effect? That's 4% of estimated total sales. Okay, that's actually a fairly large effect. This is the enforcement letter. This is the direct reciprocity letter. If you're not comfortable with the IV, you could just look at the blue line. That's the intent to treat. The estimated effects here are also, I mean, you can see that the pattern is similar, but certainly the size of the effect is larger in the case of the enforcement letter. This is direct reciprocity. This is indirect reciprocity. The pattern looks similar, but there's no, we can't distinguish it statistically from zero. The tax morale, it just blows up. And there's nothing. And the placebo letter also is barely indistinguishable from zero, but there also seems to be a pattern. Now, of course, this is, you know, you could just say, oh, well, yeah, the statistically significant effect is coming from enforcement, and then all the others are, you know, insignificant. So yes, enforcement is the whole story, but you can't really say that because the size of the effects really look very similar. This is you know, basically OLS, and this is IV. But if you look at this, you know, I took the confidence intervals out. You can see that the sort of pattern is very similar. And actually you can test for the differences across these coefficients, and certainly there is no statistically significant difference across coefficients. That's really important. So this is my last slide. There's a transitory effect on total debt, which the size of which is related to the automatic accrual of these taxes, of tax duties every quarter. Quantitatively, even though they're not distinguishable from each other statistically, the blue line is enforcement. You see that it's the larger effect in every case. It turns out that, well, for small firms, this is about 4% of their estimated total sales. Of course, the total effect is driven by the impact on small firms. So the fact that the impacts are not distinguishable from each other across treatments suggests that the effect is probably coming by from the fact that small firms receive a letter and they realize that they've, you know, all of a sudden they thought they were sort of just going under the radar, and then all of a sudden they see themselves as visible to the tax authority when they thought they were not, and they just, regardless of the content of the letter, this in itself may just be a signal to them that they are, you know, possible subjects to audits and controls in the future. So it could be that we could be interpreting this as so basically an enforcement effect across the board by basically increasing the firm's perception about the probability of being audited. And this is actually broadly consistent with this paper by Clevin and others. Emmanuel Saez is in that paper, which basically shows that this or suggests that this tax morale stuff is not so important, because basically they show that people cheat when they can. You know, in an experiment where they actually increase the probability, the audit probability for two groups, they find that those that have income tax withholding at the source basically don't change their behavior at all, while those that self-report their income do change their behavior significantly, which suggests that, you know, if you have tax withholding at the source, then from your employer, then you can't cheat. I mean, someone else is paying your taxes for you, basically. So there's no way that you can cheat. Whereas if you're reporting them, then you can cheat, and that's what they show in that paper. And I guess this evidence would be broadly consistent with that.
Obviously on an important topic, tax evasion, important not only from a public finance point of view, we need money for the state, but important from kind of a building the rule of law point of view as well. The paper describes a very neat and clean experiment, and it's cleanly written up. I kind of take it as axiomatic that nothing in research is actually simple, but the narrative of the paper makes it seem simple, which is nice from a reader's point of view. There are existing studies doing some very similar experiments in terms of these letters about tax compliance. Few of them from developing countries, and I think one thing that I would have liked to have seen played up a little bit more might be the particular uniqueness of Venezuela right now in terms of these issues, especially, one unique thing the paper adds methodologically is this attempt to tease out reciprocity for provision of pure public goods, or public goods that the firm consumes directly, versus reciprocity around kind of using fiscal powers for redistribution. That seems relatively politically salient in Venezuela, and I would have liked to have seen a little bit more about that context. But all really an interesting setup. My main kind of worry about the results in the paper, I think Daniel basically completely addressed and diffused in the last couple slides of the presentation, which have progressed a little bit, I think, since the version I had. And that, in the paper version I had, talked about the ranking of the size of these effects, the enforcement being bigger than the reciprocity effect, being bigger than the tax morale effect. And so these are the results, the peak, only looking at the firms below the median, the peak effect comes from the August 15 wave of reports. And you've got a treatment effect of 3.8% for the enforcement, where the tax morale is just 2.2%. And if enforcement is significant and the tax morale isn't, but then I think just precisely as you've already said now, it raises the question of, is the difference between a significant and an insignificant result itself significant, and maybe not in this case. So do we have a result here or not, and especially since the placebo worked kind of well at the peak. So I would embrace your interpretation at the end here that maybe this is all just one big placebo effect. The other thing I wanted to ask about, and the presentation again gave me a little bit more rationale for this around the timings of these tax payments, was that you present all the results in terms of these, I can't remember how many there were, dozen or so treatment effect dummies interacted with the 2-weekly period that they're reporting. And I'm just wondering why I wouldn't be justified in doing what I kind of manually did in Excel, which is to average all those 15 treatment effects for each of the treatment arms to get an average effect. It's not that these are insignificant, I just didn't go through the trouble of calculating or trying to figure out what the standard errors would be. But then things look maybe even more similar across the different treatment arms. On the other hand, you might have a better shot at getting your standard errors down. We'd have, you've got a dozen times the sample size if you did that. So I wanted to hear an ex-ante rationale for why we're studying these treatment effects separately at each point in time instead of pooling them together. Okay, some of the similar points, questions on the specification. I was a little bit confused by the dependent variable, actually, this tax balance variable, because this is, as you said in the presentation, a stock rather than a flow, and this links to the issue of how separable these results are over time. If I was behind on my taxes last period, then I'm behind on my taxes this period, and do we actually have a dozen different experiments at 12 different points in time, or do we have some cumulative process of falling behind? I'm not saying that that undermines your results. I actually can't quite think through for myself what that does, but these things seem linked by using that stock variable instead of a flow variable, and I was wondering, is there an obvious reason not to just use current tax payments instead of a stock measure of indebtedness? I already said the thing about why we're measuring T different betas. A very minor thing, just clarification, it seems that you had treatment effects from May 30, which is before the intervention happened, and I was just confused about the timing there. And then, again, maybe this is all water under the bridge at this point, but the estimation doesn't actually formally use the placebo treatment, right? You could do a triple diff against the placebo treatment. We know, looking at the results, what it's going to tell you, so yeah. Nothing's probably significantly different from the placebo. Okay, so maybe the last substantive and maybe the only helpful thing I have to say is on mechanisms or proving a non-result. Let's say, certainly on the tax morale and maybe on the others, if we accept that there's a non-result here, the tax morale letter didn't do anything, right? You can make one claim, which is that the tax morale letter is ineffective, and I think we can all accept that and we're done and we can go home. If you want to make another claim, which would be a more fun claim to debate, that raising tax morale is ineffective for increasing tax revenue, then I still need some convincing, right? And this goes to the point that Felipe was raising about credibility. Either beliefs about others' behavior don't matter very much, or the letter failed to change recipients' beliefs. And it's kind of an out-of-bounds suggestion usually, collect more data, but I'm going to say it nevertheless. It seems like that would be, in principle, testable. In the best case scenario, I don't know how much time has transpired now. In the best case scenario, you go back, you do a survey of your firms, and you find out their beliefs about how many other firms are paying taxes and so on. You try to show that you moved the needle on the intermediate mechanism, because I would still be really excited by a non-result that the tax morale letter was ineffective if you also showed that you did change tax morale. That would be kind of interesting. Short of going back to the actual firms, I would even be kind of interested if you could show me that your letters, the text of your letters, could change tax morale or beliefs or anything in a sample of CAF students in a laboratory setting, just to show that your letter is not just too long, didn't read, the end. I think that's about all I've got.